Hey everybody, it's Eric. Welcome back to the channel. In this video, I'm walking through another 0DTE trade. I'm practicing a little bit different kind of entry here. The day is a little bit different today. And real quick, just so you kind of understand, the market did have a big move lower. We gapped down on the back of some news out of the Middle East. Israel has attacked Iran, and there's a lot of headline risk out there around retaliation as we head into the weekend. It's also Friday the 13th, which may or may not have anything to do with this. But anyway, I went ahead and wanted to get into something, but I didn't, because it's such a volatile day, I wanted to make sure my risk reward was in my favor. So I didn't want to, for example, sell a credit spread for $1 and be risking $4 and then get blown out on either direction. This thing could bounce back. And if you sold a call spread, you could be underwater. Or if you sold a put spread, the thing could just keep going and go through your strike. So I decided to go with an out of the money put debit spread. I bought the 59.55 and I sold the 59.50. I bought it for a debit of 75 cents. So the idea here is now I have some negative delta. You see the theoretical line here. And if the market starts to move lower, this trade would start to make money and it would max gain out below 59.50, where the spread would become worth $5 because it's a $5 spread. So my risk reward for right now is 75. I'm risking 75 to make 425. However, this is low probability because if the market doesn't move or just chops around up here, this trade's going to go to zero. And I'm okay with that. I'm basically risking $75. There's no stop. There's no, none of that. So the idea here, though, is not that I expect the market to close below 59.50. It could very well do that. The idea here is if I can get a big enough sustained move down to, call it 59.75, or even down to this level, I could then sell an offsetting put credit spread and I could convert this to a put butterfly. So let's go to the table, and here's where the strikes are right now. Tasty has the kind of weird position here, but basically if I sold a short put spread and I sold the same strike as my put debit spread, this would create a butterfly. I have two short strikes at 59.50. I bought one put above and buy one put below. So if we go back to the curve, now that creates a butterfly. If I were to do that right now for a credit of 50, let's call it, let me just lock this in, 55 cents, then that credit offsets the max loss right now. That $75 that we talked about would offset that, and now I would only be risking $20. But man, this is low probability. You really like you would have to have it pin in here, and I'm not really expecting that. However, if I can get at least 75 cents for this put credit spread, like if this moves lower and I can get a better credit, then all of a sudden I'm offsetting my max loss. Obviously, the more credit I can get, the more this becomes risk-free and you can actually make a small profit anywhere else. So this is a kind of general idea of what I'm trying to do today, where I'm entering into a put debit spread. If I get the move in my favor, I'll look to maybe offset that and lock in whatever gain I have with the potential for a larger profit at the big 59.50 level. Obviously, if we get a really hard sell-off and I can get $1.50, this just continues to increase my minimum gain area. This is the grass part of the forest with a single tree. As of right now, if we unlock this, I do not have that. So I'm basically risking $75 right now, but I need to move lower. So let's see how it plays out the rest of the day, and I will update the video at that time. See you in a minute. All right, we are coming up on the lunch hour and my trade is completely underwater. And this is exactly why I bought a put debit spread for cheap, because I didn't know if we were going to rally or keep going. The market has rallied pretty hard. I think when I was doing the previous video this morning, we were around 59.80. We've rallied up back above 6,000. I think 6,000 is going to be kind of a magnet today. But as we got to 6,025, what I did was I basically took on more risk. So remember, I'm risking 75 to make 425, but it was low probability. But that's okay. I knew this was going to be a crazy day, so I didn't want to risk a lot. And if the market completely rolled over, I'd have a favorable risk reward. And this is also exactly why I didn't sell an out of the money call spread on a quote unquote bearish day, because had I sold a call spread, let's say 6,000 when the market was trading down here at 59.80, that trade would be completely underwater, and my risk reward would be skewed as out of the money selling goes. So what I did was I was willing to take on a little bit more risk. I don't typically try to keep my risk to $75. And what I did was I put on a 6,000, 6,005 call credit spread. So this is an in the money call credit spread. I received a credit of $4. So now I'm risking 100 to make 400 on this individual trade. And what this did is when you combine the two trades, remember we're trying to build a forest or some green grass where we have the most profit zone. Right now we're taking a chance on a kind of a pullback, but what this did was I got $4 for it, but now it's covering the $75 loss if we can pull back to 6,000. If not, I'm risking $175 now. So at this point, I don't really want to risk anymore because the day's pretty crazy. But if we do get a nice pullback, I still have negative delta. I can still look to sell an offsetting call spread to lock in gains up here, because if we start to make money, then I can lock in and create a risk-free trade. Right now, I'm not risk-free. I'm risking, I basically have $175 at risk, and I actually need the market to drop 20 points for me to be profitable. I can probably capture some gain if we drop 10 points, but we'll kind of see how that goes. Let's go to the table, look at a short put spread here at 6,000 just to kind of see what this might look like. So if the market does drop and I can get, what would I need? I would need $1.75. Let's say I can get $2. If the market does pull back to 6,000, I could probably get a credit of $2. Therefore, I'd end up in a risk-free trade with a couple profit areas. But there's a lot of if, ands, and buts with that. But let's see how it goes. Right now, that spread's trading for 90 cents. So I'm not going to put that on now. I'm willing to simply just risk the 175. We have a long way to go before the day's over, and we'll see if traders want to hold the risk into the weekend or if we get an end of day sort of fade. All right, that's it for this update, and I'll update the video here shortly. All right, I'm back. It's a couple hours later. We have about 2 hours before the close, and we did get a nice little fade. We have been chopping around the 6,000 level, but we finally dipped below. And so for the original two spreads that I've been talking about so far, I'm in the profit zone, but again, 2 hours to go. So what I did is I went ahead and added that short put spread that I talked about. I got a credit of $2.50. If we look at the order real quick, I got $2.50 for the 6,059.95. And this is the trade I am left with. Now I still have negative delta and additional downside profit if we really get an extreme sell-off towards the close. I don't know that that's going to happen. But either way, I am covered on a relatively volatile day. Ideally, we would pin at 6,000 and I would get a max gain. But if we get a huge move and massive sell-off later, I could have a pretty decent gain as well. The other option too is if we were to sell off pretty hard in the next hour, and let's say we got down to 59.60-ish, I could take the whole thing off for more profit. It's just if I hold the expiration, the max I can make in this grass area is $75. So right now I'm guaranteed 75 minus commissions, and we'll see where it lands. Thanks for watching. We'll see you in the next one.